Welcome, everybody. Good afternoon. My name is Andrew Stevenson. I'm the current secretary of the Crowdfunding Professional Association. Thank you for attending this webinar. It's part of our educational series hosted by the CfPA. The CfPA's mission is to foster the growth of the regulated investment crowdfunding economy by supporting issuers and investors, and by working with intermediaries and other crowdfunding professionals in the broader capital raising ecosystem. In addition to educational programs like this webinar, the CFPA advocates for the regulated investment crowdfunding industry before regulators and legislators. The sort of this past October, we had a very successful a visit to Washington, D.C. for our annual summit. We met with a number of different offices, and we're able to make sure that our priorities were included on their legislative and regulatory agendas. For those of you who were able to attend the SEC's small business program earlier this week, you may have noticed that there were a few questions and a few polling questions that actually came directly from the CFPA's policy positions. So while a sort of younger organization, we are an effective organization. And if you're not already a member and you would like to join the CFPA, you can check out cfpa.org. They have lots of information on how to join, as well as things that are coming up, including kind of save the date for this coming October for our next annual summit. And let's see. So now we have a sort of great program about the kind of the variety of investment opportunities that are available. And I will go ahead and turn it over to Paul Lovejoy to kick us off.
Hey, Andrew. First off, I love the CFPA. I was in Washington, D.C. last October. I got to see you guys in action. And I got to say, the attorneys that are representing the CFPA are phenomenal. I was blown away. And yes, we are definitely punching above our weight. This is a great organization to join. Andrew, I think you're selling it a little bit short right there. I just really want to emphasize how awesome the CFPA is and what an impact we're making for investors in the entire capital raising ecosystem. So thank you, Andrew, for all the work you do. I know you were a lead actually in October with a couple of the congressmen. So thank you. I see we got Allison here now. And I know Allison, she had the framework set up for our meeting today. Allison, do you want to kick it off, or should we just start talking about Reg A, Reg CF, and all the goody stuff that's in the different novel instruments that we're seeing today?
I think we need to ride off of your momentum, Paul. I think
okay.
Whatever you've got going on in your coffee cup, I wish I had in mine. And I have to say,
awesome.
before we jump into this, the Lovejoy sign behind you makes the entire thing. Like it's fantastic. You definitely keep going on the regular there, because I think that if I were both I look at this as an investor and an operator and a creator and a person who raises money and all the things, where things are heading, the amount of momentum Reg A has picked up, I think is a noteworthy starting point. I feel like we're at a point in this industry that is, I don't want to say a maturity point, because I feel like those of us who spend every day in it, we feel like we've been mature for a while. We're like waiting for you guys to catch on to this. But there is an adoption maturity point where numbers now on an annualized basis are expected to hit the billion, not the million. And you start looking at deals that are doing pre-IPO, that are raising in a methodical manner in which they're using all of our regulations. We're hitting a place where the adoption is more mature. So I think that's like a healthy place to jump into this conversation of like where we all see this market going, but also like what things that you might find in this market you wouldn't have found anywhere else and you might not be aware of.
Yeah, Scott, I think you made a really great point right there about the maturity of the industry, because as individuals, as someone I see you, you're doing different webinars and podcasts. You're all over the media, so yeah, it's not it's not immature for you, but as an industry as a whole, yeah, you're right. That is where the maturity is happening. And I think Reg A is a good starting point because typically how we talk about it is the mini IPO, right? You know, the Reg A mini IPO, but Reg A is more than just the mini IPO. It's being used as as a fund structure. A lot of times we're seeing this in real estate, and
Yep.
so instead of trying to raise capital for this a mini IPO, they're setting up a fund structure and they're becoming essentially asset managers. So what you're
Yep.
doing is you're investing equity into an asset manager. They're managing assets that produce income and they're sharing that income. So Fundrise, they were the first really to adopt this Reg A fund structure. But I'm seeing it across different funds now. Impact kind of funds. C Note has the flagship fund. That's a Reg A fund. Now, there's a fund I got into back in 2019. And it's called AHP Title Fund. Have you heard of this, Scott?
Nope.
Okay,
New to
well,
me.
so yeah, so what it does is it's a asset management company, and they purchase mortgage at a discount, distressed mortgages at the discount. And here's what's really innovative about this one is that they actually tried to work it out with the homeowner at a cheaper price because they bought the mortgage cheaper. I don't know why
Right.
banks don't do this. It seems like a no-brainer. Yeah, you're going to lose money anyways. Anyways, so they do this and this deal is going great. And this is a true story here. So this Reg A fund, it's chugging along, monthly cash flow, which is unusual for this is it essentially Reg A. You can turn an equity investment into an fixed income investment, which is really cool. So it kind of flips the script on equity when you use it as a fund structure. So, anyways, this AHP fund, it's chugging along. COVID hits, and all of a sudden, there is this artificial environment where homes aren't being distressed anymore. So the fund needs to do some kind of jujitsu to try and stay alive. They use it to leverage. And what ends up happening is a private equity company steals our loans. And so now we're in a situation where they're hitting lawsuits all across the country trying to prevent us from collecting this. And, I'm about to lose money on this deal.
Right.
And so are thousands of other Reg A investors. And so what does the asset manager decide to do? He starts a Reg CF litigation support fund. And this is really interesting now. So this litigation support fund, it's also an equity structure, but they have it set up as a waterfall deal. So the investors in the litigation support, if we win, they
Yeah.
get their money back first. Then is the compounding interest from the investment, which is a 15% annualized compounding. So what's really cool about this is that the IRR is baked into the investment vehicle, which is really unusual. You don't really have that situation unless you have these kind of waterfall deals that are set up.
Right.
Then the original investors, they get their interest compound, then the principal, and then the management gets left over. So here's what's really neat about certain litigation support offerings. This one we're doing RICO. Have you heard of RICO? Do you know what RICO is? It's
I
the
mean, like, are you talking about?
racketeering.
Yeah, the racket. I
Yeah,
was just say the
yeah, it's
cocaine
the
cowboys.
so right, exactly. So
Yeah.
it turns out this private equity firm is operating like organized crime. And in fact, it's been this whole drama. I'm getting
I thought
emails
that was their
about
business model. Is it not? Am
yeah,
I?
right. They're doing witness tampering, Scott. This is crazy what's going on. And I'm seeing these emails the judges are having. It's this whole drama, and it's this perfect investment vehicle for not only regular people to democratize, investing. Now it's a tool for justice. Also, Reg CF. So it's the what we have is so versatile, so amazing, and that's why I wanted to open up with that story, just because of the possibilities that we can accomplish with these different investment vehicles and regulations. So I know what you're doing. You have a lot of waterfall deals in on your platform. How does that work compared to, let's say, this litigation support offering?
Yeah, I mean, it's a great question. And I just want to back up a second on one of the things you said there with the regulation. I've been involved in crowdfunding / retail private markets since 2016. Before that, technically, invested in Republic, one of the first investors in Republic, and others since then, obviously King's Crowd and on and on. At Gigastar, we're working on something very unique in the revenue sharing space. But I think what's more important about it is that, like, my position has always been long on the regulatory part of this, because you described this like incredible story of like how this can be used. This is kind of funny, but I mean, like, and unrelated, but like Bill Ackman will not disclose whether I think this fund is going to be any good or not, but he's going to have a publicly traded fund, the PSUS, I believe. And it's, again, doesn't matter whether it works or not. It's very novel. And we're starting to see creativity even in the public markets, which I believe are inspired by our private markets and what we've been doing. Yeah. And I think that without Reg CF, without Reg A and Reg A Plus and some of the advancements and changes that have been made, you wouldn't be able to do things like what Gigastar is now able to do with creators, allowing you to own revenue stakes in these companies or into these creators, or create a fund on a Reg A Plus, or do a 506C where you could basically run secondaries into other companies and create an ATS and just all the things. We enable, through regulation, we enable any person to access every single part of this market in a different way. And some may be excluded from some of the areas because they're not accredited, but they're still getting access through maybe a Reg A fund, or maybe it's through rev share, or maybe it's through, whatever. So I just think that we're in part of it's technology, part of it's people like opening their eyes and just being forced, frankly, into being a little bit more, as you said, jujitsu, being a little bit more nimble and creative in what we're doing. But what it has led to for us, and what I think the opportunity for us is, whether you believe AI is coming for all of our jobs or not, humans will always consume. That's what we do. We are consumers of every level. And whether it's doom scrolling or watching this panel or listening to a podcast or reading a Substack or whatever the case may be, people will always engage. And AI can be in and out of that engagement, but the bottom line is people like to consume. The creator market, as a result, has grown 10x every 3 years, basically. It's a $250 billion market right now. It'll be $500 billion by 28. It'll be probably $1 trillion by 30 at that pace, maybe more. YouTube paid out $100 billion in revenues to creators. They've taken about 55% of the total amount that for example, on YouTube makes, but that includes, there's Spotify, there's Patreon. I mean, there's so many, Twitch, there's so many platforms now. So what we looked at was, by using Reg CF, could we securitize creator revenue on, let's say for now, YouTube AdSense, which is a publicly traded company, Google owned YouTube. AdSense is reported monthly. Creators are paid out monthly from the platform. It's the same on every other platform too. They're basically paid out monthly. And they're growing at an insane click. They have no infrastructure costs, generally speaking. They can have ups and downs, but usually they have a baseline that is fairly durable. And so we looked at it and said, if we securitize this, and there's another element where we've tokenized it and make it so that it's cross-border and it's tradable on this new secondary that we have going live next month, we have made it to where investors are coming on our platform and generating anywhere between 7 and 22% IRR on their investments by simply owning a fraction or a percentage of a creator's revenue. And the creator's revenue is just on that AdSense channel. So there's no murky, did you make a brand deal or not? Whatever. It's just this reported Scott, straight into your wallet.
So is the investment vehicle a revenue sharing note, or is it
it's
equity?
A creator revenue token, so non-equity.
So
But
it's
they
a
own
creator
a
revenue
percentage
token.
of the revenue channel. So if you're making money on AdSense, let's say let's say we have money coming in on our YouTube channel. I also sell t-shirts and all these other stuff. I do events like this. I'm not sharing that revenue with you. I'm sharing AdSense only. You're plugged into our CMS, or I'm sorry, CSM, so that we literally are paying, YouTube's paying you in an escrow, and then you're paying us, which distributes to the investor, and then you're getting paid the remainder of the money. So everyone can see it. It's all on blockchain, running
Right.
it,
That's awesome.
making it tokenized and making it investable and now tradable. But the most important part is that you, like, for example, you'll have a creator who did 30, 40, $50,000 last year on YouTube. It is a matter of, obviously there's some taste making in here and knowing your market, but it is not uncommon for that person to the next year do 100 or 150 or 200,000 if they're consistent and growing. And we have seen creators, if you want to look at, for example, like Mr. Beast, he was a $30,000 a year creator at one point who now has a $30 billion, revenue stream. If you bought, 1%
So what kind of
of
return
that.
multiples? Yeah, yeah. What kind of return multiples are the revenue? So is it kind of like you get 10% of revenue at a 3x multiple? Is that
Yeah, I
something?
mean, it's so there's we can think of it kind of like bonds. We offer versions where they only have a 5-year revenue share license. Basically, it could be 10. Most all of them are in perpetuity because that's the best investment. We look at the creator, their background, their plans, their expansion plans, growth, etc., channel growth, in particular, engagement, comments, not just views. I like to look at what types of advertisers are operating on their platform. In other words, what's their audience like and what is the audience value worth? And that kind of dictates to me how much potential revenue they can generate. Yeah, so you would invest
There's one
in,
other
yeah,
thing. So the secondary market
yeah,
aspect, the revenue. It's so you're trading revenue sharing tokens on a secondary
yep.
market, and the value is based on actual performance of the creator. It's not like I think this creator is going to do well, but this creator is
Well,
doing X,
I mean, I think
and you think
there's always a little speculation similar to any market. The
right,
difference between this and again, this is just the difference why I like revenue, because at the end of the day, in particular with creators, there's no underlying assets other than maybe IP, but that depends on what IP it is and channel. So if I look at like Start Engine secondary, it is completely speculative as to whether or not these companies are doing well or not. Most of them are pre-revenue. If they are revenue, have they grown? It's unknown. If
that's
they're
exactly
not,
my point. Yeah, yeah,
CARs, like I don't know what's going on
right,
in
right,
their life.
right, right.
On
Yeah,
this, I can see every single month they have
yep.
distributed either a little bit more, a little bit less, consistent. They have seasonality, whatever. There are reasons for volatility. But what is, I think, more important is you look at the trends in the space and you are doing a little bit of speculation and saying, well, look, one of the big trends, this is so stupid, but one of the trends on the social medias, so the kids say, is this looks maxing. I don't know. I don't even pretend to know what the hell that is. But if you go and look at some of the creators on our platform who happen to be in like the wellness and appearance and in lifestyle, their numbers are trending upward without them even doing look maxing stuff, just because that trend is there. So if I wanted to see that coming, I would go, who are people who are probably going to capitalize on that? I might buy their shares right now if they were available over the next 4 months. And usually there's a tail, right? Like the trend goes down, but it still kind of peters. It doesn't just cut off, it kind of peters off. So you could almost do a 2 or 3x on investing in a handful of creators who are in that trend, and they go boom and then they come back down. But the thing is, there are
Right,
still lifestyle creators, so they're not going to go to zero. So again,
right,
I'll wrap
right.
this up, but like the comp that I think is important here for investors, when you look at startups, every asset has its own profile. You're investing for different reasons. You talked about the litigation fund and title funds. You're looking for yield. You're looking for waterfall in this case. You're looking for a long-term
Cash
exit,
flow.
IPO, big thing. Here, I have much faster payback turnaround than with a founder. Probably not going to have the 100xer, but our platforms collectively haven't really seen the 100xer for anyone yet either. So I think that we are in a position where you have the ability right now to make your money back plus. And I think that Gigastar as a company is working on other products that would enable us to own even more of the creator and of course make that investable as well.
Very cool. Well, Allison is here. I'm dying to hear what she has to say. I know she's quite prepared for this, and I just would love to hear anything that you want to share here, Allison.
Well, thank you. It's wonderful to finally get here. I appreciate you setting the stage for me. And I really was taken with the point that Scott was sharing is that there is really going to be a different investment type that's appropriate for every different type of investor, whether you're looking to go long term or short term or more speculative, or looking at what is actually that you are purchasing and what is that ability for you to get paid. So, what needs to go right and what maybe is a risk that could be out there that would prohibit you from getting your intended outcome. So I'm really interested to talk with you both about those kind of filters around how to look at these new investment types that are just available now as we start to see this more complexity, and being curious about how we can look at how people are getting paid and what could actually go right and go wrong with those types of investments. With
Yeah.
Yeah, go ahead, Paul.
Yeah, I think that is so true. Having all these different investments, these underlying assets that are available now that you can actually invest in, it's weird because I think we're still looking in a dark room with a flashlight on this one. We don't really even know exactly how much we can invest in and what different types to. I just love investing in all of it. You mentioned there's a different an investor for each type of asset. Well, I'm the investor that likes to do. I want to know it all about. I just think investing is such a fascinating thing, and to be able to. So I invested in a nonprofit. Okay. Now,
I need more
obviously,
guys
you
like
can't
Paul
do.
at my cap table.
Obviously, you can't invest in equity in a nonprofit, right? So this was a revenue generating community kitchen, and it was a debt instrument. It was a 3 year, 36 months fully amortized loan at 10.5 interest. I'm like, man, I didn't know it could be profitable to support a nonprofit, but it can be. That's how crazy this investment universe is. And it's only getting big. We're just discovering it. So yeah, very exciting times.
So what do we think is actually driving this change in the market for these exciting new structures to come out, and the types of assets that you can invest in?
I mean, I think that there's a couple things. I mean, I think that we did see the 2020, 21 and 2 Robinhood boom. It got a lot of people into the space, very similar to like how, for better or worse, prediction markets are getting people into gambling and vice versa, gambling into prediction. It's just one of those like boats rise tides, tides rise boats kind of scenarios that gets it started. I think that technology, AI, blockchain in particular, loosening of regulations, people's being warmed up to crypto, whether you like it or not, all these things are kind of convergence. And actually, I'm publishing it soon, but I wrote this white paper about this convergence of retail investors and technology, effectively. And we are hitting this apex mountain for, if you want to be a part of something, the access is there. And I think that is what has fueled demand. I think that demand, while it was kind of under the current and people like us knew about it and we're kind of trying to build towards it, the greater public and larger private equity markets didn't know, didn't care. Their vests were on, they were in veil, they didn't care about all of us retailers out here. Once that started to bubble up and they heard about it, they began to get interested, and you saw $50 billion invested across private market infrastructure over the last 2025 to now. I was working on a project at the time that basically got started and then disappeared before we even got off the ground because of this activity that just turned on like a light switch. Then you have Trump and the Trump Act and the retail investing and retirement, and that's a thing that starts a conversation. Then you have this private credit boom and now uncertainty, so now they're looking for liquidity. They see interest on the demand side. They see access of tier one assets. And in the middle is this blockchain and technology that for the first time in history actually allows it to happen at the same time. And that we're not even at we haven't even seen it yet. We're still on this side of the mountain. We haven't even gone to the other side yet. All this stuff is coming to brew right now. And I think, like anything, any other innovation you've ever experienced in your life, whether that's apps and Facebook and stuff like it, SaaS, et cetera, now AI, when you give tools, demand, and access to smart people, to ambitious people, they're going to come up with stuff you couldn't have even thought of. And I think we're just starting to see it. Like I can't even imagine in 2 years what Paul is going to be investing in and what we're going to be talking about.
That's right. If I could just piggyback a little bit on what Scott said, I totally agree. The technology, the culture, everything has changed to create this environment where we all seeing these wild investments, these new emerging novel investments. But I think there's a deeper component at play too, is this loss of control. When you are investing in something, now all of a sudden you're regaining some of that control and saying, you know what? I like this. They're not getting the attention they deserve. I could do something about that. And there's real power in that. And I think that is a deeper motivation, I think, that I'm seeing within this broader market. So that's what I'm seeing, Allison.
And with that impact investing that you're so engaged with, Paul, and you were just mentioning, are you seeing that there are these novel structures for these investments that you're seeing come out, or what are you seeing trending for impact investing specifically?
The holy grail now for impact investing is being able to come up with a life cycle or regenerative business that has a defined kind of life cycle. So they're trying to come up with novel equity ways that are non-transferable or non-inheritable. And it goes back into a community governance structure. So instead of having passing down on more of a hierarchy kind of bequeathing, it's creating a business model that will eventually be community owned, but investors still can get the big returns with it at the same time. So that's I would say, the most radical thing I've seen so far, which is pretty cool. I'm going to definitely invest in one of those. Let me tell you, if it ever come along. But I think really the next step though is these revenue sharing notes that Scott is talking about, and I think he is actually hearing more about that. I think he's actually blazing a trail for a lot of other people to adopt this revenue sharing model, including revenue sharing tokens. I think that's such a great idea. Let's make it cross border. I think and I think we'll see revenue sharing go into early stage equity, because I think there's a real big problem with you know children's books companies having a safe, or a CPG using these safes. It doesn't make any sense. Let's have some
Yeah.
patient revenue sharing notes. Maybe let's get a higher return multiple, but maybe wait a year or two before we start sharing that revenue. So I think that's a model that's desperately needed in our space. That's not happening, because I'm tired of equity in a lot of these companies. I just don't want to own a piece of their company anymore. I want to share in their revenue.
Yeah, that's a great point. And for the benefit of maybe some of our new investors in the audience, let's just touch on and break down, what is a safe? Is it equity? Is it debt? Is it neither? This is really a contract that could become equity in the future, right? So what are investors really needing to ask themselves when they're looking at or coming up upon a safe? You had said, you're looking for revenue, which you wouldn't necessarily get with your traditional safe. But what are those questions that investors should be asking themselves about? What are they going to want to get paid?
Yeah, I'll tell you. I think first of all, I think safes are incredibly um, ambig uh, ambiguous.
Ambiguous.
You're just agreeing that you're going to agree in the future, essentially, is what it is. We agree that um, We think it's going to be this amount of our company. We're just guessing. We're just throwing a number out. We think it's going to be this, and we agree that we're going to give you equity at some point. We don't know how much. We don't know what kind of equity. Is it voting share? We don't know. Nobody is. So I think the SAFE was created specifically for an incubator. And it was great for that incubator, but the fact that now everybody uses, I think it's a real shame. And I personally am educating founders on the value of using revenue sharing versus equity. And I think there's going to be equity fatigue where people just aren't going to want to own a percentage of a CPG or one of these other companies. So that's my thought on safe. We need to have clearer terms up front because it gives founders an out having a safe without really thinking through their business life cycle.
That's a great point about the traditional safe being quite ambiguous. I know Silicon Prairie has recently introduced the Safe Plus R, which is that R for remarketing, which provides a little more concrete terms for the investor and the issuer to know how that contract might eventually end up, which is the option for the issuer to remarket the security to another buyer or for the investor to choose for the issuer to repurchase or buy back that investment from the investor. So another new novel innovation on a traditional structure, which is exciting. But as far as the move into revenue shares, have we talked yet? Because I did miss a little bit of the first part of the conversation. Have we talked about the difference between revenue share versus royalties? And can we break that down a little bit?
We did not. I'll take the first stab. Feel free to add to it. I mean, someone in the comment section actually just asked a question about IP. And a lot of times when you think of royalties, you're thinking of, I always think of Mr. Wonderful on Shark Tank, but the idea being that there's a certain fixed percentage that you're just going to get. And a lot of times that ends up becoming, something that the company, it could be directly from revenue, it could be from dividends, it could be from profits, it could be a lot of different things. Revenue share, and by the way, usually that's at the end after all expenses. Revenue share, again, depending on the contract and the business, I'm going to speak to it from a creator standpoint where the revenue is coming directly from AdSense or Meta or Spotify or whomever. You're getting the money up front. Like you're the investor and you're going to take 2%, like let's just say the creator is putting 10% of their revenue up, other AdSense revenue up for investment. You purchase it, we assess, let's say we think that this creator is, still fairly young, certainly not matured yet, definitely planning on building an empire, not a single channel. We're going to give like a 6x, 7x multiple on this revenue. So you now invest, $20,000. They're growing monthly revenue from $20,000 to, by the time we're done with this, 18 months later, they're close to $100,000 plus dollars. Whatever your fractional percentage that your investment is of that total 10%, you're getting that money every single month. And then they get paid. Then they get all of their other expenses that they're going to take out to pay for their cameras and their equipment and stuff. So you're getting straight up money on that. It's not at the end of the deal. And I think it's very attractive because to the point that Paul was making before on CPG, taking loans out and raising venture capital in a business that probably doesn't have 100 or 1,000x multiple potential doesn't make a whole lot of sense. And we're running out of investment vehicles that make sense for this. It's not just crowdfunding. It's like if I'm going to invest in, whether you're talking about the nonprofit, Paul, or you want to get into like a local, I don't know, this is a terrible investment, but not investment advice, but like a car wash chain. You got somebody who's got a nifty, spin on it. And that company at best, maybe it becomes the next Jersey Mike's and sells for a ton of money, but probably not likely. Maybe he grows to 9 or 10 of these things. When would you get paid back? How long am I waiting on this? How many decisions are you making without my, you don't need my knowledge or my input given that I'm a small investor, but like I have no control. And if I can invest in a business where you're like, look, car wash number 1 is doing, $40,000, $50,000 a month. And when we get to car wash number 5, we're doing $600,000, $700,000 a month, and that's when we're paying you. I have visibility, and I expect to start getting paid. And at that point, this is an investment vehicle that makes complete sense to me. And I think the last thing I'll say to this is like, We had a creator who I thought was the smartest thing ever. He should have hired him on the spot. He was like, I build a channel, I get to a certain amount of revenue, I raise capital by selling 10% of revenue on that channel to start my next channel, and I do it again, and then I take money off that, and I start a newsletter, and then I start advertising, and I start growing, and you're like, how much debt have you taken on? None. How many loans do you owe back on? None. How many venture capitalists have you taken money that now own part of your IP? None. This person completely owns their business. We both took a risk, he took a risk, but he owns his business. And I think we're gonna see a lot more of those, and it's gonna expand from creator. It's gonna get into these vibe coders, one-person businesses. Like, what is the best way to fund your business? Investors will always have an appetite for risk if there's reward on the other side, but the vehicle, the way the entity, the way it's done needs to make sense. And I think our stuff, our regulations, and our tools that we've worked on for a decade now here, I think is better. I think it's better fit for regular workers.
And we're and you were talking about, Scott, really the revenue stream that is from an individual creator. At what point would that become an operating business versus revenue based on an individual's income stream? And how should an investor be looking at that?
Yeah, it's funny. Staying in the creator world, there's an investor people may be familiar with, not in the, well, he is in the creator now. Sam Lessin, his wife Jessica Lessin runs the information. Sam is Slow Ventures. I recently sent him a creator who also had a business behind it. Like they had a media company, then one of the channels that they had is YouTube is massive. And he goes, it's a little too much of a business for me. He turned it down because it wasn't enough just a creator. There was like too much business behind it. I think where we're going is being able to invest in multiple parts of a business. We've only always looked at it as like either believe in my vision and me, the founder, or don't. And now it's like, no, I believe in part of you. Like, I love your YouTube channel, not totally sure about what happens with your company. Or I like both, and I want to buy into your company, and I want to help grow your sales team to grow your sponsorship and advertising. That's a different deal, different metrics, different risk, different profile. I also want to own 10% of your YouTube channel. And if you grow another one, I want to own 10% of that too. Because those two investments, I will pay back my risk on that one. And if you make it big, we win. I think you're going to see a ton of deals like that. A ton of them across every, not just creator, every business. You can break it apart. Revenue shares, particularly tokenized, securitized. And there's one thing I want to add to, but I want you guys to, we'll talk about this topic after this. Every revenue stream can be investable. And we've just never thought to do that. But I think we are entering a phase where blockchain certainly helps us, where we could literally say, I just want to invest in your new pipe fitting revenue stream. Like, it's like, okay.
And as you're talking about, divvying up these different revenue streams, it brings to mind almost treating a revenue stream as an individual asset. So asset-backed securities and asset-backed offerings are another thing that is kind of new and novel. Paul, you have actually, I believe, invested in a cultural asset, right, with your Stranger Things house investment. Do you want to talk a little bit about what you were thinking about as you were due diligencing this on your own?
Yeah, it's really exciting now that we have the opportunity to invest in a physical asset that was part of a creation of a TV show. Now, I'm a big fan of Stranger Things. I've watched all the season. Love the season finale, by the way. If you haven't watched the final season, I loved it. But I was able to get fractional ownership in the actual buyer's house of the program. And I don't know if you're familiar with Stranger Things, but they have Christmas lights inside the house, and it communicates from the other side, and all of that is in the house. And the details, the level, it's like stepping into 1988 or whatever. I mean, it's really cool, this house. And as far as due diligence goes, it was so obvious that this was going to be a winner because people love the show and they want to stay in this house. And I have, I think, about 16 properties on Arrive. That's where I bought this investment. And so these are fractional ownership of physical rental properties. And this is my highest performing one by far because of this cultural significance that it plays, and people can actually be a part of that. And you know, now it's such a fun way to earn a few extra dollars, or and to have that. Now you're also getting cash flow from that, and then you can buy the next cultural vacation rental, whatever that may be. So Mario House, I don't know, that would maybe cool. Who knows?
Well, as you were looking at that opportunity or any of these opportunities, Paul, what what do you think about when you are looking at something that's a good story? It has a good narrative. You understand the cultural momentum is behind it versus what is a good deal for you and for your portfolio? Because there's a balance there, I think, right?
Yeah, there is. So a lot of times that story will drive the revenue, and especially within something that's income producing inherently, like a vacation rental. Um, Diligence factor is this story. So stories matter very little to me on a startup early stage. It does to bring me in. Oh, I experienced this. This was my problem, and here's my solution. But then I'm going to be so scrutinizing on every tiny little financial detail that they have going, because it's not an income producing asset that I'm investing in. So the diligence on a vacation rental that I would do, I'm going to say, okay, this is a good story. It makes sense. Who's managing this house? That's ultimately what I want to know. Is this a competent manager? I think Arrived is. They have a good setup system there. So the diligence, it isn't as detailed as it needs to be to say some early stage, because of the very nature of the underlying asset.
Thank you for that. And speaking of the very nature of the underlying asset, to go back a little bit to intellectual property, a lot of underlying intellectual property may have some value where people can capitalize on that if it's current or even previous intellectual property that has been maybe forgotten about. We did have a question in the chat here about maybe someone wanting to have secondary trading rights for existing works, things like that. Scott, do you have any comments on that?
Yeah, I'm trying to like also chat.
You're doing a good job.
I'm
Yes.
multi-dimensional. Uh, at my previous business, Songbench, we got very familiar with the particular music IP rights. There was a company called Royal.io that attempted to tokenize this. There's a dozen companies that have tried to figure out a way to enable fractionalized assets, fractionalized access, I should say, to like music IP and movie IP, Marvel stuff, a bunch of it. It's brilliant, and we should, and someone will figure it out. The closest thing that exists to this right now is like Rally Road and trading cards and collectibles. And the reason is the collectible is owned by one person, whether it's fractionalized or not, there's still like one underlying person who possesses it. In music and movie rights, there tend to be minimum of 3 or 4 people associated with the ownership, and sometimes as much as 10. And some of those people are alive and some of those people are dead, and it's their family's trust, and it's their great, 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 great grandfather, and it's Elvis Presley. And it's like, it's just very difficult. A lot of inside baseball. Okay. So fractionalizing it and allowing a regular person who doesn't live it day to day they will figure it out, but it is really tough to track down and to like verify and say, well, we definitely have the rights. Like, well, Prince's estate said you couldn't use it and we didn't know it. And I invested, and now who owns, like, it's very complicated. However, I will say this. This is how I think it's going to become accessible to everyone, at least on this call in the short term. There are massive funds. Catapult is one of them. I'm forgetting, there's another one that we actually had it as an investor, and I'm blanking on the name right now. But either way, they were the people who got together and bought the Taylor Swift stuff, and then she made the new ones, and like they're very heavily in this, $1 billion plus fund. I believe that a lot of these funds, and these are guys they're very familiar with the inner workings of this, the legal, but also the family. It's a very inside baseball. I think that they're going to start using, to Paul's point at the beginning of this broadcast, Reg A funds. It makes total sense. They're going to create a Reg A fund around the assets that they're purchasing on IP and LP, and they're going to turn around and say, if you'd like to invest in the next Marvel movie, we believe it's going to generate revenue in the next 5 years, Netflix deal, blah, blah, blah. And you can invest directly in it that way. I think for the foreseeable future, that is an asset class, while it is incredibly exciting, it is owned mostly by heirs of very successful people. And we all know the story about the son of the wealthy person, not usually the top performer. They don't want to let go of these assets. And so there's just a lot of murky stuff that goes on in the space, but it is a very cool asset class. And I'm excited to see how it comes to fruition. But I do think that Reg A fund is what I would expect to see come out.
Paul, anything to add there or anything that you are
Yeah,
excited to
well,
see come out next?
if we're talking about tokenizing IP just because we want to be a part owner of that IP, even though it's not our IP, just a token, I don't really
Well,
see
I
any
interchangeably
value.
use fractionalize. I should have said fractionalize and then, rather than token, but I think I know where you're going with that.
Right. So, right, yes, yeah.
Just to be
If
clear, I just want
there,
to be clear because we use
right,
interchange
because
it sometimes and people
like
are like, what is this?
essentially it's the mirror token is what I'm talking about. Yeah, and that is one I said I'll invest in anything. I will never invest in that. I think that
No
is
forward contracts for you, Paul?
no. This is this is the territory that I will say no. There's no value into this, and I think it's just a recipe for disaster because it requires the actual platform that's offering these mirror tokens to stay in business, and so you're not investing in that asset. You're investing in this company that's hosting these mirror tokens. So if we're talking about anything is if it's even if it's legal, A, I'm never going to invest in that. And B, I'm going to give my opinion on how lousy of an idea it is for anyone else to invest in it. So I don't really have a breakdown on what Scott said. He sounds very reasonable, and I don't have any real pushback on it. I'm just offering, just want to put that out there about mirror
Yeah.
tokens because I can't stand them.
Yeah, I just want to
So,
read this to you real quick. Sorry, Elsa,
yeah,
I
go
have to
ahead.
read this. I saw it yesterday. This is so whenever I look for a new asset, I try to see how it's described. What is it in layman's? Tell it to me like I'm a 5-year-old. This is a mere token described as best it can be in a compliant way for an ad. Pre-IPO tokenized synthetic exposure. That's the end of the ad.
Synthetic
I was like,
exposure.
so you are Paul, the first investor, and by the way, I love Republic and what they're and everything that they've done. I've invested. I've brought products to market for them. That is a product that either needs to get more clarity around it or have it go through a cycle where people can see how it's working. I cannot disclose on this. I know how some of the deals are working and they are completely legit. And it's not just like a, hey, we'll see what happens, Hail Mary. But when you have to describe your product like that, it's very difficult for me to see the end game on it. That's for sure.
Well, let's break it down a little bit and talking about, the what needs to go right and what needs to go wrong and how people get paid on a mirror token type of investment. What needs to go right? What are the things that need to be in place for a return to be available for the investor?
I'm itching, but I'm going to let Paul go because I can see the wheels spinning right now.
Well, I'm trying to see what could go right. I mean,
I was waiting for that line. I was waiting for that
right.
line.
I mean, it's what can go wrong, I think, is the real question that will happen. And even if everything goes right, what are the externality costs that the investor isn't paying for? Because that's always something. So now you're influencing something that you don't aren't you don't own, and it's not your idea, but now somehow you're influencing it with a market that is trying to almost capture what you've created. I don't think it reminds me of uh, selling art on the secondary. Yes, you bought that painting, you could do whatever you want, but it's your painting to sell, and even though it's not you didn't create that, it's your asset. That doesn't happen with mirror tokens. And so it takes it one step further of trying to um, uh, instead of investing in creating value, you're investing in value already created. So there's nothing productive going on with that. I mean, how are you benefiting anything? And so when you deploy your money one where that's a real opportunity cost where you could have done it into a productive investment. Hey, if you like a 10.5% return, fully amortized loan, I got a great nonprofit you can invest in. That actually does something. We're talking about investing in something that does nothing. Maybe if all you care about is getting some money, then okay, great. But I don't know if that's an actual the larger picture. Just because it's in your financial interest doesn't make it in your economic interest. And so that's why I'm not going to say we need to ban it, we need to make it illegal. I'm not suggesting that. What I'm suggesting is don't do it. Don't buy it. Don't get into it. But invest in things that actually produce something. So that's where I stand on the mirror token. You know, if anybody wants to invest in it, that's you. But I will never tell somebody to invest in it, and I will never invest in it.
I'm going to try to prop the Sandman up and let him take a couple more swings at it. We could do a whole show on this, and I mean that literally, not just because of the mirror. There's a regulatory component of this that leaks down into the creator stuff. I'm talking about like the regulated side of everything is what I think is the most important part of this. It is what is differentiated between, I think, generally good, not good investments from return, but like better chance of success than some of the crazy stuff that's just sort of thrown out there. I would argue that a mirror is, I also have not invested in them, is not any crazier than the shit coins that are pumped up and down. And you could almost say that they're, kind of brothers and sisters or cousins at least. I think what I know about the mirror token in particular is a lot of the initial offerings they made are companies that they invested in their large venture fund. And so they're basically marking up and selling their original positions in a future outcome. And so you can actually make money. And they do actually fairly clearly state what their price is and their fee structure on it. And it's not great. I have access to those deals directly. I'm not going to put my money in a magic whatever balloon that's floating above the company. They also have a partner with a mutual investor who is the leading investor in a lot of the companies that you've seen come out recently, like SpaceX. And so they have a direct relationship to buy shares directly from those companies and say, you're getting at X, we're marking it up basically before we sell it. So we know what we're going to get roughly. And if it IPOs at 1.75 trillion or whatever Elon claims it's going to happen, maybe that definitely is a great payday because I think they're in it like a 800 billion or something, the mirror for this. This is a hype cycle. This is because we can, we do. In a world where we don't have an OpenAI, an Anthropic, and anything Elon Musk puts an X at the end of, having a new raise concurrently within the same 12-month period 3 times, doubling and tripling the price, you wouldn't have this crazy secondary lasagna that we see everywhere, where everyone's marking up deals on top of deals on top of deals. So let's fast forward 2 years, AI obliterates everything, the markets come back to whatever they're going to be, SaaS is dead, whatever we decide on. Can you sell mirrors if there's no volatility and there's no markups and there's no IPO in sight? I think it just takes care of itself. Like at that point, just like, I'll just wait till they go public. Also, lastly, I just want to say on this is people really need to think about this as investors. As retail investors, sometimes we don't get the best, information. We're trying to give this to you. Companies on the private markets who have stayed private longer are doing so because they stay private and have access to more capital. There's a whole bunch of things as founders and owners and board members and investors privately that you can do with it. Once they go public, it has to become real, like McConaughey said in Wolf of Wall Street. We don't want to do that, so we stay private. They go public, and this $800 billion valuation goes down to 200 or 300 billion. You're in at 800 billion. You will not be able to get a return on your mere or direct investment or secondary investment for a decade. And I think we need to remember that the old Amazon days of being public before they hit $1 billion in valuation doesn't exist. We have stripped that growth phase out, and now we're just remarketing it to people. That is my opinion.
Well, it sounds like we're talking really about the option to optimize short term versus really investing in a long-term sustainable business. And we have just a couple of minutes left here, so I just want to put this last question out for you both. Do you think we are moving towards a future where individual creative outputs, these are going to become more appealing for tradable financial assets versus the operating business? What's your take on that?
Well, I'll go here first, and I have a feeling I know what Scott's going to say too.
I'm going to shock you. I'm going to
Yeah.
shock you.
Well, what I think really is what you touched upon earlier, Scott, is having individual revenue streams securitized. So, and I'm doing this already. I have this a company I love, Ovanova. They do decentralized distributed energy, little microgrids all over the place. I've done a debt Reg CF debt deal for a specific project of theirs. I've done a revenue sharing note for a different one, a development, and now they have an equity offering into their own company. So I think that what you said earlier, that was one of the biggest insights of this whole conversation is that you're not going to just invest in one business or one creator even, but it's going to be all these different streams and you can mix and match. And yes, the reggae, I think we're seeing the same thing
Yeah.
here, Scott, in the future. So yeah.
I don't disagree with you. Just I'll make it quick on that. I I think that for at least the next couple of years, maybe it's 5 years, maybe it's longer. I don't think you're going to see a lot of major change. I think it will largely be public companies and investing in a venture back, this, that, and the other thing. It's going to look fairly normal. I think the shift happens as AI starts to be able to have agents running companies, and you're able to run a business that has turns new every revenue line becomes a new entity, and every new entity has its own balance sheet. And you don't have 50 employees and you need to have 100 or 1,000. It's like we have 10 and we've got 5 lines of revenue. It's like 10 people. It just changes the investability of it, the stability of it, the risk factors. And so you're going to see a flattening of companies and you'll see a flattening of capital. And the big company investments likely will be from mega funds, and the little ones will be from you and me and Allison and everyone on this panel.
Well, thank you both for sharing your insights today. This has been a lively discussion. I wish I was here for more of it, but I think we've also touched on a few topics that we could probably even do another 45 to 60 minutes on here in the future from the CFPA. So thank you both, Scott and Paul. Thank you to everyone who's joined, and thank you to the CFPA for putting on this panel today.
Thank you guys. This was lovely.
Love it. Bye, everyone.
See ya.